Hey guys, welcome back to the Crypto Wave. Wanted to talk a little bit about Animal Farm while it's still on pause and just kind of dig into the white paper a little bit more, as well as go over a couple of things. I jotted some notes down here real quick in regards to some pros and cons and also kind of what is the basics of yield farming and what the heck does that actually mean. I know a lot of people are new to the space and new to yield farming and crypto in general, as well as decentralized finance. Let's go over that just a little bit. When I get to that point, we'll do it, but I want to tie it into this white paper here while we're talking about it. And when I get to the point of the yield farming, we'll go over those pros and cons. So first and foremost, you have obviously the Animal Farm. It talks about farm mechanics. A lot of this stuff, if you're new, probably doesn't make a whole lot of sense. But in reality, it's a very genius and kind of systematic way of providing benefit or providing a return, I would say, to anybody who's invested in the Animal Farm. And this actually ties into kind of the pros and cons here because there is fees for deposits. But those deposits in this particular case actually go towards the token holders. And so what this farm mechanics page is really talking about is what fees are kind of being taken when you buy and sell certain things and what are those fees going towards. So in this particular case, pigs, which we know are the governance token, if you're not aware of the basic farm mechanics of pigs and dogs, there's a previous video that I did. But in essence, pigs are the governance token. There is a 3% sell on transactions, and that 3% sell on transactions goes towards bolstering the token itself as well as the treasury itself. So dogs, on the other hand, is a little bit more of the driving force behind some of these mechanics. Dogs are the native farming token. The vast majority of the yield farms on Animal Farm provide dogs. It is a 6%. This is actually adjustable. We've learned that through Telegram that actually this 6% tax can actually be modified. But basic is at 6% tax. I think it's set to 9 at the moment, if I'm not mistaken. But anyways, half of the 6% or 3% of that tax. So anytime if you were to have $100 in dogs and you want to sell it for cash, it is going to take $3 of that. And what it does is it takes it from you, so you end up getting $97 back. And 3% of that, you'll lose $6 of it in this particular case because it's a 6% tax. But $3 of that goes to BUSD. Basically, the contract buys it, and then that value goes directly into the pig vault, rewarding people who are holding pigs into the pig pen. So the other half, so the other 3% of that tax is then paired with BUSD and added to the liquidity pool, raising the potential floor price of the dogs on each transaction. Now there's an additional 3% tax on selling, so that's where this 3% tax, so it's actually a 9% on selling. That 3% tax on selling is burned. Basically, it takes, if you had $100 worth of dogs, you sell it, $9 is taken. 3 of those dollars basically burns dogs, takes them out of circulation, which in turn should add a little bit of price appreciation. And then obviously the values above this as well. So the additionally going into it, dogs are basically like I said, the main driving and the main farm, with the exception of if you're using dogs to farm. So anything dogs related, dogs BNB, dogs BUSD, drip BUSD if you're in the drip, and also any single stake dog earns you pigs. Otherwise, every other farm is going to earn you dogs. Excuse me, didn't mean to yawn there, but it's pretty late for me. And the reason he did that is he wants the amount of pigs being distributed to be limited. You want scarcity, and if every farm was producing pigs, then it wouldn't be the scarce token. So he has every farm producing dogs, which is the main driving force and the main force of all these taxes and withdrawals and things of that nature. So next, there's a little bit more of the farm mechanics here, and this is basically what is going to be taxed on the pigs and things of that nature, as well as any capital going into those yield farms. So 75% of all fees. So anytime you go into a farm and that farm says 4% fee or 2% fee or whatever the case it is, 75% of that goes into BUSD and goes into the pigs. 15% of that is going to go for marketing. 10% is for platform fees. We're going to go into the rehypothecation on a different video, but just know, in essence, it's a fancy way of utilizing the collateral provided in the animal farm to earn additional yield to help animal farm in its entirety. So now let's get into the actual farms themselves. So this is where this comes in, where I'd like to talk a little bit about yield farming, kind of pros and cons, and the basics of it for anybody who might be new. So obviously the pros on yield farming is in reality just the high percentages. So if you imagine if you had $1,000, we're going to make this easy. $1,000, you're going to put it into the bank account. You're lucky nowadays if you're going to get 0.1% APY or annual percentage yield. And what does that basically mean is that within a year of that $1,000, you are going to get 0.1% return on that $1,000, which, you know, if you're lucky, you might get a 1%. I don't know of a bank that'll do that, but even at a 1%, that's kind of big time in the banking world. Whereas if you go into these yield farms, you're going to start seeing things like this. You're going to be seeing 126%. You're going to be 71%, 126%. And you wonder, how did they get these values so high? Well, one, that is obviously a pro because you're getting those high rewards. And typically you are farming the local token. All of these yield farms are always going to generate some type of a localized token that's specific to their particular platform. And then really it's going to be boiled down to what are they using that token for, and what is the purpose of that token? Is there going to be burning? Is it an infinitely produced token? Is there any other use from that token other than just using it for farming? Because obviously the vast majority of people who farm are in it for trying to get the profit by providing their collateral. They're earning an interest for providing that. And what do they do with those dogs or whatever token it is? They're going to sell it immediately. And that's where a lot of these farm mechanics with when you sell dogs, how it's going to be benefiting all the various aspects of Animal Farm comes into play a lot greater. So what is liquidity itself? The way I always describe it to people, especially if you're kind of new to it, there's a lot of things that go into liquidity, but I'm going to break it down as basic as I can think of, which is basically, say you have $1,000 in a traditional market, such as the stock market. You are allowed to take that $1,000. You can then give that $1,000 to, say, the New York Stock Exchange or Webull or Robinhood or whatever you're going to use. And they take care of all that stuff on the back end. What they basically give you is $1,000 worth of a share of whatever it is you're buying. Now, what you don't realize in those transactions is that on the back end, somebody has to be giving up shares in order to provide you those shares with the money that you gave. So what does decentralized finance do with liquidity? And this is the basic of it. It allows people to provide the two sides of a trade, or what we call the liquidity pool, by creating a liquidity token that can then be deposited and people can trade against. So let me kind of explain what that means. Let's go back to the $1,000 that you guys had, and we're going to use, for all intents and purposes, we'll call it a tree coin. It has nothing to do with Animal Farm. I'm just making this up right now. You have $1,000. You would like to go into the tree farm to provide collateral for people to trade against by providing liquidity. So you then take that $1,000. It has to be equal parts when you provide liquidity. So you sell $500 of it, or obtain $500 worth of tree coins. Now you have $500 BUSD, $500 of tree coin. You then can use the yield farm to combine those into a liquidity token. And now anytime somebody does a transaction, and for all intents and purposes, let's just pretend that you are the only person in that farm or in that particular liquidity pool. Anybody coming in after you, somebody comes in and says, I want $100 worth of tree coin. So what they end up doing is they will actually now put in $100 into the liquidity pool. So now, right now, if you're the only one in there, it's 500 and 500. Somebody puts in $100, it will then increase the dollar or the BUSD to 600, but you have to give them $100 worth of the tree coin. So for all intents and purposes, we'll say it's pegged to a dollar. There's now $400 of tree coin in that pool now because somebody needed some out of there. Now somebody else comes along and is actually holding tree coin, and they decide, I don't want it anymore. I want my $100 back. Now what they do is they put that $100 into the liquidity, which puts that back to 500 or equivalent to that. It all depends on price at this point. Again, this is basic. And then they take out $100 from the BUSD. Now, all the while, if you imagine this on a grand scale, you have millions, sometimes hundreds of $1,000,000 in liquidity. So people are putting in $10,000 and pulling out $10,000 worth of the token. Now, what you need to realize is within that, obviously, there's going to be slight variances because the more people buy the local coin, the less dollars are available to withdraw from, and it goes vice versa. And that's in reality one of the risks of this is the decreasing pools. And what some people, in basic terms, there's other fancy ways of doing it, but this is a way to think about it of impermanent loss as well. So imagine now that same scenario, you have $500 dollars, $500 tree coin. If you are the only one in there and tree coin takes off and a bunch of people want tree coin, then they're going to keep putting dollars in and taking tree coin out. So the amount of dollars that you're going to be having in your liquidity is going up. Meanwhile, the amount of tree coins available in the liquidity is going to keep going down. As that goes down, that price is going to get higher and higher and higher. Now, that's actually a good thing because obviously you're losing some of your tree coin, which is going up in value. However, you're also gaining some of those dollars on the other side of it. And there's little fees in there. Each platform, whether it be Uniswap or SushiSwap or Animal Farm, they all have little fees. So all these transactions, in order to reward the liquidity providers, have little transaction fees that they then provide back to the liquidity providers to try and keep them equal. But let's think about it, and this is where one of the risks comes in, is the amount of decreasing pools. So now let's imagine, for instance, tree coin is taking off, things are going really, really well. You have your liquidity in there. You put 500 and 500. Something happens. We'll say it ends up having an exploit on the contract. Everybody's going to start dumping their tree coins, dumping tree coins. Well, what needs to come out of there? People are putting tree coins into the tree coin side of liquidity. They're going to be pulling out dollars. So what ends up happening? If you don't take your liquidity out, that tree coin is now, you're getting more and more of that tree coin, less and less of the dollars, because people are putting their tree coins back in and taking their dollars out. In essence, what ends up happening is you're going to end up holding a large amount of tree coins with almost no dollars backing it, which in essence you have a million tree coins that are worth maybe $10. And that's one of the big risks of going into liquidity. It's one thing if you were to go into liquidity, for instance, to peg dollars, so BUSD and USDC. So long as those are always pegged to a dollar, you really don't have very much risk involved there. Excuse me. But that's usually one of the farms that has the least amount of return to your value, because these platforms realize that the higher risk, it's basically a higher risk, higher reward. If you're using a pegged coin, then it's very little risk for you because you're not worried about the fluctuation of the tree coin. You're basically going dollar to BUSD. And that's why a lot of times these things fail. A lot of times anybody who's new here probably comes in here when we first started and we saw like a Cake BNB pool that was, 10,000% or something like that. In essence, it's because it takes more people. There's likely going to be less people holding Cake BNB and putting it in for collateral, because of the fact that if Cake, for instance, recently, as we all know, Cake has been going down. So the amount of value that you're actually holding in here is going down because the price of Cake is going down. And that goes the same with BNB. If BNB price goes down, your total liquidity. So going back to our original assumption, you have a $500 tree, $500, or $500 tree, 500 BUSD. Let's say nothing happens at all. You have $1,000 in there. Nobody's trading it, so you're sitting even. Well, what happens if the value of tree goes down. Well, it's no longer worth $500. Maybe it's only worth $200. So your overall value is going down even though you haven't done anything. And that's where a lot of these coins come in. So these cakes, now this is BNB BUSD, so this is pegged with BNB, so you have to worry about BNB going down. In this case, you have to worry about cake and BNB going down. You can go into a lot of these other farms such as DAO BUSD, BTC ETH. Those are both predicated on BTC and ETH. I mean, you name it, any variable you need to worry about the other side of the coin going down or going up. So a lot of these farms give you a very, very high percentage if you're using their local coin and pairing it with something, simply because that means that you're adding value to a risk of a coin that may tank down. For instance, if you were that tree coin, let's say you provided liquidity and you're farming and they're giving you tree tokens of reward, they're going to give people who are providing liquidity for anybody else a higher reward for the collateral they're providing because it's related to their local coin. Unfortunately, if that local coin has a insane amount of sell pressure and everybody puts all their collateral in and just starts farming the bejesus out of it, and then they just start dumping it on the market and that tree coin starts going down, well, you better hope that percentage that you were given, you've made your money back based on fees and things going into it. We talked about the high rewards, liquidity, local rewards, local token we just talked about. Obviously, it's going to be, I personally, very few I hold on to that are the local rewards. I really need the platform to show me. I'm personally willing to take lower rewards in the short term until I know that something is solid. And animal farms are a prime example. I'm a firm believer. Like I said, anybody who follows this channel knows I'm a firm believer in the animal farm. However, where are we at right now? We are paused. We are paused on anything dog related. Pigs is being redone at the moment. So this collateral is locked up. And I trust this developer and I trust this platform. But yet here we are. Something very, very simple that was unforeseen shut this down. And so that localized token is already an issue, even though there's all these wonderful mechanics that are talked about in this white paper of all of the farming and fees and buybacks and all that kind of stuff. Either way, here we are. You know what I mean? So just keep in mind, anytime you're farming, it's going to be very attractive to grab that local token. Just be wary of what you're going into, and definitely don't put on all your eggs in one basket. Now, you can also do some other things, and this may be coming where you see this vaults over here on the animal farm. A lot of these yield farms actually allow you to leverage, and this is a pro and a con in my opinion. So yield farming, if you imagine, you can put in $1,000 collateral into a liquidity, and some of these will actually allow you to take a loan out against the collateral that you put in. In essence, you put in $1,000 and they may let you take out $700 worth of a loan. And so what some people do is they'll put in $1,000, take out $700, put that $700 in essence, almost nearly doubling their amount of farming potential, pulling out another loan. They'll do that 2-3 times over. So they're actually farming at a much higher value than what they typically could at a higher percentage. And if it works out well, a lot of people make do on that, and then they can pay back those loans they pulled out. But with that, anytime you do leverage, you have to worry about liquidations and things like that. So that's one of the big risks on that is liquidation. If that token or anything happens on that platform, you are out that money. And if something even worse happens, then they actually take the collateral you provided and it's gone. It's wiped away. So other risks, obviously fees for deposits. A majority of these are 4% fee. Excuse me again. Sorry, again, it's very late. A lot of these are 4% fees, so definitely pay attention to the fees going in. Make sure that the percentages, that the farm is solid. That way, hopefully within at least 24, 48 hours that you're going to be at least getting that 4% back that you originally put in to try and get yourself even again. We talked about decreasing pools. That's basically the localized token, and token loss from depreciation we talked about. This, again, you guys, is very, very basic in regards to the farms. It gets a lot more complex than that, but hopefully that makes sense. So with that being said, These are the core pools. Excuse me. Farms that earn dogs. These are all artificial numbers, and now you can get real numbers on the website now since this has been live for a bit of time. But definitely pay attention. I personally like dealing with tokens that I have confidence in. So ETH, anything stable, BUSD, USDC, USDT. I like Cake. I think Cake is a juggernaut. It's backed by Binance. You can't get better than that. And BNB, I like the Binance Smart Chain. Not familiar with Belt, Dot, up and coming, not worried about it. Link is pretty solid, but again, your LP value is going to be based on Link and WBNB price action. Right now, the market's obviously on a downturn. So a lot of times what I personally do is I try to have at least one side of my liquidity being some sort of a stable coin or something like that. But again, I'm very much a lower risk, low reward type of person. I'm willing to go into a farm like Animal Farm that's got some longevity to it, knowing that I can get a 20 to 50% APY over the course of a couple of months, but I have very little worry, and I can go to sleep knowing my collateral is in that particular farm. So lastly, obviously these are the ones that create this is still dogs. I apologize. These are single stake that produce dog, and then this is the commission. All right, so actually we'll end here. I'll end this video here. I just wanted to talk about that a little bit. We'll go more into the dynamic emission rate on the next video, and with that also I want to go into the rehypothecation that happens on the Animal Farm. So hopefully this makes sense. It is really late. Hopefully I didn't ramble too much. Hopefully it makes sense, some basics on yield farming and decentralized finance. And I appreciate you tuning in. If you haven't already, like, subscribe, spread the word, and I appreciate everybody who's watching. Have a good night.